at all. And that being said, we're now going to gear up for the Fireside Chat. That's right. This is where we're focusing on the cross-section of payment and lending. And we also have two prolific speakers joining us right away. So I'm going to request everyone, take your seats. It's going to be an interesting fireside chat and on a very feisty topic, especially when we're talking about the cross-section of payment and lending. So let's look forward to this session. And this particular session will be spearheaded by Mr. Nitin Gupta, founder and CEO, Unicards. And joining in conversation, we have with us none other than Parag Rao, country head, payments business, consumer finance, digital banking and marketing, HDFC Bank. So we're going to bring on board both of our speakers to come on stage so that we can get up for this interesting fireside chat. Once again, I'm going to urge our members of the audience to please also keep your tweets coming using hashtag GFF. Welcome, sir. Wonderful to have you here. I think our team is still setting this up for us, but I believe it's just the two of you. So we're just going to request you to take your seats. We'll just give a quick makeover to the stage as well. As a team, we are also the cross-section of all the details on the stage over here. But that being said, a warm welcome indeed. Thank you very much for joining us. I'm going to quickly hand it over to Mr. Nitin Gupta to take forward this fireside chat. Over to you, sir.
Hi, everyone. I'm Nitin, and GFF, thank you so much for organizing this wonderful event. It's a real pleasure to be here. I know you want this to be very spicy, so I've prepared a list of tough questions for Parag, and here I go. Parag, you've been a veteran banker for 20 years. You've been in HDFC since 2002. You have seen everything in payments, whether it's consumer side or the merchant side, from prepaid cards, credit cards, payment gateways. You have seen everything in lending. You head the digital banking for the bank. How has been these 20 years in terms of evolution of payments and in terms of evolution of credit for India, in your opinion?
That's a pretty interesting question, but first of all, I think it's lovely to be here at this forum. It's awe-inspiring. I mean, I'm sitting in this room and I'm feeling so small. You know, it's exactly like payments. Whatever you do, I think the roof is sort of, you can't even see it. It has unlimited potential. Well, to answer your question, yeah, 20 years has been a pretty, how do I say, awe-inspiring and learning journey. Okay, yeah. When I got into the payment business, by the way, I joined HDFC Bank from a completely different industry. It was FMCG prior to that. All of FMCG, the bulk of my career. So it was a completely different domain for me. But then I entered it with the thought to say, hey, fundamental business principles are the same, whichever industry you look at. So I just plunged into it, and it's been an ever, journey of constant learning. From the days 20 years back when relative today, you could say payments was primitive, but it was still quite advanced at that point in time. And now I've been learning day on day. There's always something new, which is why I call this the payment business or credit cards as the lux of the FMCG business. You know, it's glamorous. It's a wonderful mix of future-looking strategic content, but at the same time, transactional operation, huge amount of detail, and it's a wonderful place where any budding, professional in the financial services space would actually learn. Having said this, I think what we've seen is the evolution of, in the initial, let's say the first 10 years, the evolution of many payment forms which were conventional, the debit, the prepaid, et cetera, building up form. Then the card industry itself was pretty nascent at that point in time. We were probably the last players in the industry. And I think we all were learning the ropes in 2-3 things. and some of these basics still remain. So how do you build scale? How do you build profitable scale? How do you manage a good built-up book? That means what we call portfolio management. How do you churn customers? How do you get them to spend? How do you manage delinquency? How do you manage operating costs? Good amount of learning and expansion, etc. So I think the industry was chugging along, how do I say, at its own growth rate, reasonably sheltered, if you may call so, over the first 10 years. Post the 10 years, when the initial green shoots of, if you may call so, digital and sort of growth started coming in, of course, pushed by certain events, economic or ecosystem events like Demon, the whole Silicon Valley explosion, etc., is when it started becoming even more interesting and actually became challenging for a lot of professionals, including us, wherein two, three things started happening. Different types of players going beyond banking sort of entered the industry. People started looking at the form factors and started questioning the existing form factors and say, hey, new form factors, what can we do? Okay. Payments, which was reasonably isolated from the traditional banking, started becoming even more integrated. And then questions like Nitin, you've asked for, which started emerging even 8-10 years back, to say, how do you convert a payment transaction into a loan? And that was the genesis of the starting point of this whole question, which you're saying, the cross-section or intersection of lending and payments. Okay, and so a lot of that became interesting. True competition in that sense, is the way we call it, actually started coming in. And then, of course, in the last 7-8 years, we're in 2022, I keep on forgetting the 3 years of pandemic, but 7-8 years back, when the digital sort of, the whole, it started dawning on us, is when, bang, the whole denominator base changed. Suddenly you started looking at a base which was 100 has now become 1,000. Okay, paradigm shifted, customers started asking for different things, significant amount of different innovation, what you call innovation, new ideas, thoughts coming in, rapid consumption also happening at the same time, rapid ask for new different types of thing, and this convergence between payments and I think lending has become even closer. Net, for any financial service player, the way I said, if I were to summarize all that I said in sort of one chain, in today's world, what are we living in? We're saying that you can't isolate payments with lending, and let me add a third leg of banking also. And I say banking, I mean the typical liability side. Okay, all the three are interlinked. When you look at it from a profitability perspective, when you look at it from a loyalty and customer stickiness perspective, and when you look at it from a customer wallet share perspective. All these three are deeply interlinked, and probably some of the questions you'll ask, we can sort of delve into it a little more. But fundamentally, what we're now saying is, on one side, you manage technology to be able to innovate and constantly provide products and services, ever needing demand. The second aspect of the way probably a business manager looks to look at it is, how do you manage this immense scale? Payments is about scale. Profitability comes about through scale, and those paradigms have also changed. So how do you manage scale, the infrastructure, the investments, the go-to-market, all of that? And the third bit is, how do you manage this elusive thing called customer loyalty or customer stickiness? Because simple, you just want the guy to keep on coming back to you again and again and again and again on a sustainable basis. And when you put all the three together, you still need to build. You need to have a profitable business, profit enough to pay for your business and you reinvest into the business, profit enough to give back to your stakeholders. Okay, investors, if you may call so. Yeah. So that's a sort of summary.
Very helpful, very helpful. But prodding there further, right? It's long been said, at least in India, you can't make money from payments. There are companies globally like PayPal who have been successful in making money from payments. But at least in India, whether it is consumer side payments or merchant side payments, payments is used as a hook to acquire the customer, to engage and retain the customer. But you're practically not making money in the transaction because you're operating at bare minimum cost. So credit becomes a very important means to make money from that customer, or banking for that matter. How much would you agree with this statement? What's your view?
So I agree with your statement when you look at it using a conventional lens. So I can't convince my CFO you know, to give me more investments because he looks at it the conventional way, how much money do you make, EBITDA, etc., etc. But the way I think we need to start looking at it, and all serious players in the payment business and even banks too, is you need to look at it from a commercial, a holistic look at the way a customer looks at financial services. I made a brief mention about a statement saying that payments, lending, banking are interlinked. And it leads to profitability. Unless and until you don't start looking at it holistically, it's not going to do. And I think all of us know it, and we build it into our business model. So look at it this way. When you say someone offers payments, not too much money, okay, given the pricing, but then you want to cross-sell. What's cross-sell? Cross-sell is about building revenue. It's also building stickiness and annuity income streams. Okay, coming to your question. Can I use the payment and payment rails to lend to you, okay, and thereby make you sticky because I make money on the loan? Can I ensure that you pay using my network, but then I have your account at the back end, and then I sort of make money? So that's the way I think you need to increasingly look at it. Look at it holistically from all the financial service products that you may have on your suite, okay, and that's the direction in which way. Then in that case, what you do is, if you have 3 products or 4 products or 4 cohorts or 2 cohorts, whatever you may look at it, one of them could be payments, where your margins are dropping, unit margins are dropping, okay? And that, by the way, is globally happening across all. You look at it as whether it's MDR, interchange, whatever you call it, whether it's intervened or natural market forces, you will see unit margins dropping globally. Okay, and the only answer to dropping unit margins is scale, period. Okay, then you make money on absolutes, you don't make on this thing. And so therefore, payments is about a scale business. Therefore, a lot of your investments, your go-to-market need to be focused on how much a scale can you build in. Okay, but that's not enough. Okay, then you need to ring fence using other financial service products which give you annuity streams, which give you stickiness, which give you, how do I say, extended tenure of customers onto a loan, etc. And so to answer your question, doesn't it make money? In the conventional way, no. But when you look at it holistically, I think it makes tons of money. On top of it, because the nature of payments is transactional, you have the customer's wallet. You have the opportunity to have the customer's wallet on a day-to-day basis. So that is invaluable. Ultimately.
Fair enough. That makes sense. Look at the customer holistically. Continuing to the topic at hand, the cross-section of payments and lending. Today, as far as my knowledge goes, on the consumer side, HDFC Bank has 3 distinct products where payments and lending come together. One is credit cards. The other is your BNPL product called FlexiPay. And third is the EMI on debit cards. I would love to understand, how does the bank, are there more such products, first of all? And how does the bank look at these different products from a customer segment point of view, from a strategy point of view, from a profit pool point of view, from objectives point of view?
Okay. So 2-3 dimensions in which I'll try to answer this question. When you look at the profitability curve, well, yeah, obviously credit cards is up there, okay, in terms of potential profitability, and then sort of as you go down the thing, debit, lending actually comes before that, debit, and then maybe sort of UPI, the profit pool sort of drops. However, the role of each of these products, I think, is very clear. So to answer your question, why would you have a credit EMI and a debit EMI? Okay, well, the answer is, let's say on my bank base, we have 65 odd million customers. I've got only, 17, 18 million credit cards issued. The rest of them have debit cards. Why should I not offer them an underwritten debit EMI kind of product? Because they have the instrument in their hands. Okay, so the point is saying that, can I offer lending across all my instruments? Is the point which you hold. Okay, that's point number one. Another angle which I think you need to look at it is that different credit products have different streams. Even within loans, you have from the you have subprime lending onwards, PL, business loan, all in the unsecured line, and then you have secured loans. Customers have a choice of picking up each one depending on his convenience, on his mode of repayment, on his cash flows, on his future capability to repay, so on and so forth. So on and so forth. Similarly, lending in these three products which you talked about, they actually cater to different types of customers. Slightly better yield, and I don't mean it in a negative sense. People use card and card loans. A card 30-day credit is finally it's an OD. It's an OD line. It's a dynamic OD line which you pay back, etc. You get loans on credit cards also if you choose to use them. A BNPL or FlexiPay type or a BNPL product typically is an entry-level lending product which targets small ticket conversion into a loan, and thereby, and the way I look at it, it's a funnel for acquisition, but it also helps onboard a lot of new customers to lending and get them into a habit of lending. Okay, so each of these products actually has a slightly different role the way it has evolved. Okay, is there overlap? Answer is yes. Okay, but is that overlap minimal as we speak? Answer is definitely yes. Is the upside to grow on each of these form factors? Definitely yes. Okay, so I'm not too worried about whether there is an overlap or not. I think it's very clear that each of these three products, and probably many of the other products which you now have credit on UPI, and many other forms which will come in. I think customers will find their own convenience and level of factor in which what they want to use. You want credit on the fly, you want planned credit, you want planned EMI repayment purchases, you want collateralized, you want non-collateralized, multiple forms in which a customer does. So it's actually a good choice to the customer, but fundamentally I'm saying I don't see too much overlap. Each one will find its own place of water. Okay, but do you need all of these form factors to be able to address different customer segments and different needs of one single customer? I believe the answer is yes. You need to have a product suite of lending solutions.
So let me push this thought process further. You mentioned that there are 65 million customers of the bank, about 17, 18 million customers have a card, the rest don't. Right? If I look at the overall credit card market as well, there are about 40 million unique card holders. And while this number has doubled up in the last 5 years, there is an argument out there that, hey, why is this 40 million, not 80 million? And the same applies back to HDFC Bank as well, right? Why 17, 18 million card customers? Why is that number not 30, 35 million for you? So what's holding you back? Or what's your opinion of why the bank, or why is there this larger perception that one needs to be very conservative when giving out a credit card product to a customer?
Okay, so I would not use the word conservative. I would say prudent. I would use the word prudent. Why are we in the asset business, or why should anyone be in the asset business? It's to, one, you need to build a sustainable book. Okay, by sustainable, I mean a book which survives and grows over multiple credit cycles. That's point number one. Obviously, it should give you profitability, but that still comes later. More importantly, as a player in the financial services space, especially in lending, you're dealing in liquidity. So it's important, and some may call it a very altruistic thing, but I think it's hard reality for serious players in the lending space that you need to be a responsible lender. So issuing credit, you have algos, you have all sorts of things. You can issue credit to anyone. The point is, the story only starts there. What you need to see it is to look at it right to the end. Like I say in credit cards, there's only 2% of the story which starts when you issue a credit card, and so therefore headline numbers are nice. Okay, but how do you build a sustainable book? How do you get the guy to keep on coming back to you again and again and again, and to ensure that the guy avails of credit, but at the same time doesn't go delinquent? Okay, and so you got a responsibility as a lender also. You got to look at that whole cycle. Okay, and mind you, I think. So is the answer to say that can you underwrite many more customers than you answer to? Probably yes. Each player needs to understand his own level of credit risk and appetite, which he need to do. Okay, but I think more importantly, I think you need to, and that's the way. And I'm talking like a complete banker. That I think responsible lending is the I think responsibility of all players in the market. We can't be here to build up bubbles and therefore create artificial credit cycles, negative cycles. I think that's not what we want. A sustainable growth in the economy happens with good, prudent lending practices. Okay, there will always be a particular set of customers who will say that I didn't get a loan. Okay, but I think it's important that, and in the lending space, I think patience, prudency pays off.
So pushing
I
that
don't know whether that answers your question.
well, it half does, and that's why the remaining half of the question. Would the bank differentiate between a customer who gets a credit card and a personal loan? So for example, would a bank give a credit card but not give a personal loan? Or alternatively, give a personal loan but not give a credit card? And just tying back this question to your previous answer, that's why I'm provoking
Well, let me tell you.
provoking you.
Well, let me tell you. I think the credit algos built for PL and cards, they're similar only to the extent of about 70-75%. 25% there's a difference. That difference again because of the nature of the products which you have. PL is a planned offtake and a planned repayment product. Credit cards is not. Credit cards is talking about impulse lending or impulse buying and therefore lending, reading from that, etc. PL is not. Okay, without getting into too much of detail, from our own understanding, 20 years of understanding credit behavior between these two products, there is a significant difference in credit behavior between, say, a product like a PL, although they are pretty close, both are unsecured, okay, difference, and you need to build those into the algos. Okay, let me tell you for example, one thing. When there's a bad credit cycle, typical consumer behavior is that, you start off with saying, I protect my secured loan first, or the most pyara loan, if you may call. So if I have a home loan, okay, I will do whatever, I'll ensure I don't default on that. Okay, typically what happens, credit cards come the last, because you can revolve, you can do all of that, and then you can do a balance transfer onto another card, and so on and so forth, etc. That kind of behavior or differences in behavior impacts credit, credit lines and credit behavior or delinquencies on the different products. So by nature, therefore, of that kind of customer experience, the credit underwriting is different from a PL, etc. You really can't compare.
Fair enough. Fair enough. I will now turn the lens around banks and NBFCs. There's some NBFCs who have done really well around the BNPL or EMI business. Bajaj Finance is a case in point. They really dominate. Now, as a bank, you have significant advantage. You have a significantly large customer base. You have significantly lower cost of funds. Why is it that an NBFC is able to, at least from a perception point of view, dominate in the BNPL EMI business? What's your take there?
Well, I think Bajaj has done a wonderful job. They're probably the one NBFC who's done good in this particular segment of what we call consumer finance and, of course, PL, etc., etc. We, in fact, admire them and look at their practices, what they actually do. Okay, but the market is pretty vast. I mean, in fact, the consumer finance market is just about starting to sort of pick up right now. Even if you take all of card spends and all of consumer finance and PL put together, I think the opportunity is significantly large. And I do believe that there's space for many more players to sort of do it in. Having said this, okay, these are tricky businesses. They're glamorous businesses, by the way. They're very glamorous businesses, but they're tricky businesses, okay? And so therefore, any player wanting to get in needs to have at least 2 or 3 key things in place. One is, of course, you've got to have a significantly large distribution width and depth to be able to cater to the kind of consumer demand which happens. Second is you've really got to have an extremely strong yet dynamic credit underwriting infrastructure built in, because these are loans taken at the moment of truth, which is at the point of sale. Okay, which means your credit decisioning cycle ranges between, say, 3-4 minutes to maximum 30 minutes, if you may call so. Okay, so you've got this whole sort of infrastructure, capability, risk, all of that necessary to do that. Okay, and then the way you look at this business, these businesses once again are low tenure, seemingly high IRR businesses, okay? But then, of course, there are strains on profitability. So you need to look at these products as within a suite of larger lending products because it's a funnel for getting in customers. Okay, any serious player in this business needs to actually look at that. Okay, so there are only a couple of players as we speak right now, but I do know of quite a few players who are serious about this business, and you'll see a lot of action happening in this space.
And from the bank too, I believe.
Absolutely.
Wonderful. My last question before I open it up to the audience. Banks versus fintechs. Where does the bank feel that fintech is competition to them? And where does the bank feel that fintechs are partners?
Okay, I think the last 4 or 5 years has gone in this huge debate. ये मेरा customer है, ये किसका है, क्या है, मैं कर सकता हूँ, वो कर सकता हूँ. I think that's gone. But I think that at least in the last 2 years, at least what I've seen, I think a little bit of, if you may call so, sanity has sort of set in. What is emerging out of it, at least the way we see it, and I would urge many people to do this. I think each player in the ecosystem, whether it's a bank, an NBFC, an e-tailer, a fintech, whatever you, I think brings to the table its own strengths. I think the problem happens when we all think we're Superman and we can do everything. I think sticking to the knitting with the basic principle of business is, I think, one. But there's ample enough opportunity, and I think that's the way to go of partnerships happening, wherein each player brings to the table their own strength. Okay, that's point number one. Number two is, I don't think any one individual entity can crack the market on their own. Okay, it's just not possible. Okay, but bringing together forces and bringing together far more value to customers, I think, is the nature of the game. Okay, and the third important economic thing is that standalone trying to do everything is just not going to help you build a profitable business model. Ultimately, I presume serious players are in this game for the medium to long term, which means you need to build a good economic model. Okay, partnerships actually help in crunching the lifetime cycle of this model. So I see more and more partnerships, potential partnerships happening, and I think that's the way to go. What we've got to fight together, I think, is the fact that whether it's in payments or even in lending, if you may call so, we've just about scratched the surface and just about getting in right now. Yes, the growth has accelerated in the last 3 to 4 years, but I think we've got a huge headway to grow. Okay, and if the market grows, everyone grows. So I think that's the way we need to look at it.
Fair enough. Fair enough. Makes sense. I will now hand it over to the audience if they have any questions. We have somebody there.
Hello, I'm a chartered accountant, and I read a book wherein it mentioned that banking is required, banks are redundant. So what reply you would like to give to that author? I was just going to search the name of the author. So
Banking is required, but banks are redundant. Well, if you define banks as the traditional, brick and mortar buildings, people sitting and, doing paperwork and underwriting you or looking at big ledgers, etc. Well, yeah, that kind of bank, I think, is dead. Okay, and the banks of tomorrow will necessarily have to be like the fintechs or the attributes which fintechs sort of bring to the table in terms of innovative, agile, but also bring to the table or continue bringing to the table conventional banking attributes like trust, safety, managing risk, etc. I think it's a good amalgam too. So yes, the traditional banking which you saw maybe 30, 40 years back, maybe that's redundant, but the new banks or the banks of the future will necessarily have to morph into saying that I retain the good values and attributes of traditional banking, okay, and I imbibe the new attributes of the new age. So that's to come. I hope that answers your question.
So banks will become tech companies.
Yeah, we all have to change. It's about change. When the environment changes, we all as entities have to change. We know in our MBA classes, great examples of hugely successful companies which have overnight folded up. Okay, that's just about that, not changing. If you don't adapt to change, I mean, I don't think anyone can survive. Okay, and so banking as it was 50 years back necessarily needs to change. And I think the reason why we are all in this room as a big, great, homogeneous mass of people focused on financial services and technology is exactly this change.
So one last question. My father was a microfinancer and he always invested in people, not the business. So what is your take on this? Whether business or the person, entrepreneur?
Well, okay, let me try to answer this question. I don't know the complete perspective of why you're coming, but let me try as I've understood it. Okay, any organization is an institution fundamentally made up of people. Okay, all organizations are run through people. And what do I mean by people? I mean the innovation, you call it. Innovation stems from here. Innovation is not a fruit you pluck off a tree. It comes from here. Teamwork builds energy. Teamwork converts dreams and visions into actual reality. Okay, motivated set of people can achieve far more than, than sort of things which you can put on an Excel sheet. And I can keep on going on and on and on. Ultimately, any change, or if you look at even the history of change, change has been brought about by just someone asking different questions, or a set of people asking different questions, and believing in that conviction and actually driving it. So yes, I think at a philosophical level, it's extremely important. Organizations are run by people. Organizations are run by the best people, the most motivated people. The leader of these organizations, I think, need to take that into cognizance, to say that it's finally people who drive outcomes. Okay, the organization, the technology, these are sort of, inputs to only help you, assist you on the way. But it's finally people who make the difference.
Hi, I have a question, Nitin.
We will take one last question. I think our times are up.
So, hi Parag, Rohit Krishna.
Yeah, hi.
There's this conversation that in Web 2.0, the digital or the technology companies, through payments, primarily have built strong ownership of customers. And over time, the profit pools of lending and wealth will also shift. And this seems to be one of the big questions for traditional banks. What is your house view, or your view particularly, on whether it's Web 3.0 or Web 2.0, how do banks gain, or are banks thinking that there is risk here in terms of losing customer ownership? And what is the way forward in Web 3.0, or whatever other way banks feel they will consolidate the ownership of customers?
Well, you're talking to a banker for 20 years, so my answer sort of is pivoted to that. So technology and choices today, I think, are if you may call so, they're giving choice to the customer. So I don't need to stick to one service provider. I have a choice of going to anyone else. Okay, so that is evident. We've all got to embrace that reality, okay, and accept the fact that choice. And so therefore, any serious organization needs to look at their customer offerings and keep on ensuring that core value which customers see, I think needs to sort of build it. Okay, is there a possibility that customers will go away for you if your core offering is poor or not up to mark? Answer is definitely yes. Okay. So I think that reality is then we've all of us in this room, all of us outside, etc., have got to sort of buck up, pull up our socks and ensure that our product portfolios, the way we sort of address customers, etc., I think needs to change. And that's why I think this whole merger of, if we call it conventional, traditional business and technology, assisting you to sort of be in that thing, I think exists. And that's the reason why we're all there. Having said this, when it comes to money, when it comes to wealth, when it comes to the way individuals look at who can take care of my wealth, I think that insight, that psychology, you need to, it varies by country to country, by the way. You go to the US, it's different. In Europe, it's different. In India, it's different. Okay. From what I have seen, at least in India, all of us, you, me, everyone put together, ultimately, whatever be the jing bang and whiz and etc., you need someone trustworthy to be able to take care of my money. They don't use it, lightly when they say institutions have a fiduciary responsibility to managing your wealth. Okay, and so therefore going beyond technology and all of that, etc., brand, trust, consistent good customer service, consistently having values, a good governance structure, I think are important to build brands and trust, especially in the financial services space. It's not just enough to have processes and technology. And that organization which can I think successfully build both and marry both together, I think will ultimately hold the core, if you may call, to use the word as you go, the bulk of the customer wallet. Okay, so this may sound like a philosophical answer, but that is truly in reality. Okay, so you need to have both. You need to have both, especially in the financial services space. It also works in other industries, but at least for the financial services, clearly technology, contemporary products, dealing with you in the way you would like to do, important. Okay, brand, trust, good corporate governance, good consistent practices, I think both are equally important. Both put together makes for a potent and sustainable sort of business proposition in the future.
Wonderful. Thank you, Parag. This was great. Thank you so much for sharing your insights so candidly. Really appreciate it. Thank you
So much. It was a privilege sort of here. Thank you so much.
Thank you. Thank you very much, sir.